watching this today, I welcome you. We've been doing these live streams for a very long time now. The focus tonight is why I don't invest in stocks. Okay. And I'm going to dive into the exact reasons why. Before we get involved in that, I want to cover our opening ground rules. Same things we always cover because I've tuned in any time before you know the rules. Number one, why are you here? Know why you're here. Know what your purpose is. If you don't have a reason to learn something, you're not gonna. I talked to a guy. He's a client actually. I talked to today. He's like, I can't get through. We have this thing called the Sacred Account. We have a course for it. He's like, I can't get through the Sacred Account course. For some reason, I keep getting hung up. Can't get through it. So I asked him. I was like, hey, know the purpose of the Sacred Account, not what I say the purpose is. What's your purpose? Why do you have one? What are you going to use it for? And he was like, I don't know. And so I told him, go back and find out, why do you have one in the first place? And so I sent him the list of benefits and everything it does. And I'll look at this and come up with why you have one. And if you don't, if you don't know your reason for having one, nothing in the course is going to make sense because you don't have a reason for learning it. Right? It's like reading the owner's manual of a car that you don't own and never will. You're like, why am I learning this? So if you're tuning in, that's the first thing I want you to do is, number one, what are you here for? Why are you trying to learn? Why are you here? Right? What is your purpose? The second thing is, I want you to think about, of all the financial stuff you've heard, okay? Because a lot of us, we hear, investing and finances and taxes, and we're like, man, this is way too complicated. This is a little bit too hard for me to understand, right? Someone says the audio sounds funky. How's the audio sound? Is that good for everyone else? So we hear about finances and we're like, this might be a little bit too much for me to understand. It's too sophisticated. We actually have to remove that mindset. Okay. The idea that we can't know about money, the idea that it's only for the sophisticated, that it's only for Wall Street, that it's only for the wealthy, that's something that's not true. And so it's basic math and vocabulary. And so if we can understand the basic math and vocabulary, then we can learn about money. Right. But if we can't have this audio, or we have audio sounds good. Okay. I'm hearing that the mic is cutting in and out still. Let's check on that. See if we can. So if we have this mindset that, we can't because it's too sophisticated, then we're never going to attempt to. Right. And if we never attempt to, then we don't learn. Okay. So we have to remove the idea that we can't know about finances. The second thing we got to remove is that we know it already. Okay. I've heard all of this, and so I don't need to learn anything else. That's also not true. Right? So somebody that doesn't have a purpose, somebody that doesn't think they can know, somebody that thinks they know it already is not going to be able to learn about finances. And I'm here to tell you, like, even for me, there's more to learn. Right. So I want you to have your mindset right as we're getting into this. Okay. The second thing is, if you have questions, be sure and drop those. We will go live intermittently throughout. So if you're watching, I'm still getting that the mic is breaking in and out. I wonder if it might be the internet connection even. We just moved into our new place here, so it could be our Wi-Fi. Okay, cool. Let's disconnect anything that doesn't need to be connected. Thank you. Good. It's probably the Wi-Fi here. But the other thing too is asking questions. So if you do have something that doesn't make sense, right? If you do have something that you want to clarify or something that you want to go over a scenario, drop those in the chat. Okay. I will go live with you throughout this and I'll answer questions and we'll talk on air here. If you're on Facebook, we'll just go live in the comments. Right. And then the other thing as well is, I want you to think about, how are you going to use the information? Okay. How can I produce with this? How can this be something that I actually use instead of just having it be another webinar? Because right now, more than any other time in the world, right, we have so much access to social media. We have so much access to, videos and TikToks and YouTubes that majority of us, we watch these things and then we don't do jack squat. So I want to challenge you, do something with the information tonight. Don't and sometimes we pay for events. We go to events that we pay good money for, and then we still don't use the information. So when it's something that's free, it's like, okay, cool. This was some education, some entertainment. I'm going to challenge you. If you don't use it, it wasn't education. Okay. And it's weird entertainment. You could do tons of other things on a Friday night, right? So use the information. The other thing that I want to let you know is, one thing is, as Nano Aquino, he's on my team. He's going to be reaching out to you throughout the webinar. So if you're a client, if you're new, if you've never contacted us, you've never watched this before, you'll probably get a message from Nano. Nano works for me. His goal is to connect with you, answer your questions. And he's gonna want to set up a call with you after this, whether that's tomorrow or early next week or whenever, just to see if there's anything he can help with. So he'll be doing that on Facebook and also on Zoom. So if you get a comment, a message, whatever from now, that's who that is. That's why he's reaching out. Okay. Now, without further ado, okay, I want to jump into our topic. Okay. And our topic again, why don't I invest with stocks? Okay, and there's good reasons for that. First, I'm going to tell you what I invest in instead. Okay. My first big investment was in myself. It was in my own skills, my own ability to earn income, to provide value in the marketplace, to sell, to market. Like those are the first things that I went all on. Okay. And so that's the first thing. If you're watching, you've never invested before, that's probably where you need to go first. Okay. Now, currently I still do that, but I also do a lot of buying of life insurance, gold and silver as stores of value. I borrow against them so that I'm still earning the return on those assets. And then I loan those out private lending investments with real estate. So I'm mortgage on lots and lots of property, right? And so I get these monthly interest payments. And so that's where I do my investing. Okay. The reason why is for me, investing is all about one thing right now. Okay. Until I am financially independent, investing is only about passive income that exceeds my savings, expenses, and taxes. And the reason being is at the point that I achieve that, I'm financially independent, right? If I'm not there yet, I'm not financially independent yet, which means I'm financially dependent. I'm financially dependent on having to trade time for money, okay, on having to have a job. And there's nothing wrong with producing value, but I'm saying the obligation to. Like for me, one of my stories is my mom died when I was 21 years old. Okay. She had stage 4 cancer, was diagnosed in spring of that year. By Christmas, she passed away. Okay. Literally, I think 3 days after Christmas that year. I was working a pizza delivery job at the time. Okay. So I was delivering pizza, and the day of Christmas and on Christmas Eve, I couldn't get the day off. Okay. Because I couldn't find someone to cover my shift, and I couldn't not show up because then I would get fired. And if I lost that job, I couldn't pay my bills. Right. So I literally had to work delivering pizza, like crappy job that I didn't care about at all. I had to work and do that job, trading time for money, because I had the obligation, and I missed the last Christmas Eve I could have had with my mom. Right. For me at 21 years old, that hit me like a ton of bricks. And it's not always that extreme. We've all had the inconvenience of, okay, well, I want to do something, but I can't because I have to work. Right. And so this idea of I want to have passive income that exceeds my savings, my expenses, and my taxes, that unhooks that obligation. Okay. If I have that equation where I have that passive income showing up, I don't have to work anymore. If I want to, I can. Right. And I'll tell you what, as you build that, the work that you do becomes your choice. And when something is a choice, it becomes something that's more of a creativity. And it's something that you're opting into and you're doing because you want to and you're happy about it, not because you have to, because if you don't, you're going to starve. Right. Very different mindsets there. So that's how I invest. That's why I invest right now. Those are the only things that I invest in, myself and that. Right? Anything outside of that is out. So long story short, if we wanted to end the course right now, I would tell you that's why I don't invest in the stock market. The stock market doesn't provide that for me. I can't get that. I can't get passive income that exceeds my savings, expenses, and taxes in the stock market like I can with my private lending deals, with real estate, with life insurance, and all of the different things that I use. Okay. So if you're watching this and you're a client, like that's the goal. That's the thing that I've been preaching, telling you, helping you words. That's what my company does. If you're not a client and you're just like, I just tuned in, that's the game. Okay. And we never got taught this in school. Why? Because in school, we're going to school to get good grades so that we can job, so that we can have the 40-year career of trading time for money, so that when we're 60, hopefully we can retire. Okay. 2 problems I have with that philosophy. The average Nobel Peace Prize winner is 61 years old. Okay. So why would we intentionally get out of the game and retire at 60 when we know that 61 is when most of these people are hitting their stride? Why would that be? Right? Now, financial independence and retirement, these are 2 different things. Financial independence means I don't have to trade time for money. It doesn't mean I don't do anything. It doesn't mean that I retire on the beach in my RV and I travel the world and I never produce value or help anyone ever again in my life. No. It means I don't have to have a job. Because I don't have to have a job, I can start the business. I can start the nonprofit. I can start the charity. I can volunteer full-time for my church. I can do whatever it is that I'm passionate about without having to think about my income. I don't have to think about my income, which is a degree of being selfish. When I remove that selfishness, right? I can then focus solely on other people. And when we focus solely on other people, if it's a business, that's the best kind of business there is. I'm obsessed with my customer. It's the only thing I care about because I don't need to take a paycheck. Right? And so when I think about that, same thing if I'm volunteering for my church and I don't have to think about, oh, I've got to leave because I have work, or, I can't donate that much because I don't have enough. None of that's a consideration. It just goes away. That's what we're trying to get to. Okay. And I think that the amount of inspiration and creativity that we have access to in that type of environment is something we've not tapped yet. You might like your job, but it's not like you're experiencing freedom every day, probably. So that's the first problem I have is the average person, the average Nobel Peace Prize winner, 61 years old. And if we're being told to retire at 60, we're exiting. Retiring means to retreat. Most retirees, they don't do a business or whatever, they retire. And so they're not going to be able to get the Nobel Peace Prize, or they're not going to be able to start the business or do the thing they care about. Okay. The second thing is the life expectancy of the average human is like, I think 84 years old. Right. So if I retire at 60, that means that I've got 24 years left. Okay. What's bigger, 60 or 24? 60. So I went to school and worked the first 60 years of my life so that I can have fun for the last 24. Okay. And that's the problem, guys, is even if you even last that long. My mom died at 60. I was her financial advisor. I set up her retirement plan, and I was telling her the entire time at 60, that's the age you'll be able to use your retirement plan. It's going to be awesome. She turned 60 and 9 months later, she's passed away. So I watched that and I was like, not only is the average life expectancy 84, sometimes it's not even that. Right. And so I don't want to defer my entire lifestyle and hope that I have this 24-year left shot where I can go, enjoy my life. And so the retirement model is based on the stock market. Okay, so I'm gonna dive into a couple of different things. Now, if you're a client of mine, you've heard this a million times. We're gonna run everything through this filter. Okay. So when I'm investing, I'm gonna use my whiteboard. Investing means clothe my capital. Okay, capital being money, right? So I'm going to literally, like, I'm putting clothing on my money. And so I talk about with my investing, I only invest in things that I like. I only invest in things that I understand. I only invest in things that fit me. Okay, I only invest in things that fit my goals. I only invest in things that are vital. And I only invest in things that are fit priced. I'm not going to overpay. Now, where did I come up with this? This is what I do when I pick out clothes. It's what you do when you pick out clothes. So if we're clothing our capital, why would that be any different than when we're clothing ourselves? We only wear clothing that we like. We only wear clothing that we understand. We only wear clothing that fits us, our bodies, right? It would fit the goals, the things that we're going to use it for. If I'm in Tampa right now, if it's 90 degrees, I'm not going to wear snow pants. I'm only going to wear clothing that's vital, right? I always make the joke, I'm going to wear underwear before I wear a Gucci belt. Underwear is vital. Gucci belt's not, unless I'm commando, but telling you that that's not how I do it. So I'm going to wear the underwear before the Gucci belt. And then number 6, I'm not going to overpay for clothing. I'm not the guy that's going to, pay $300 for a belt. You can't convince me that that's a good idea. So when I'm investing, I'm looking at these same things. Okay. And so that's the majority of where I look at, okay, when I'm doing an investment, I literally am going to run it through this system. Okay. Now here's the first thing with stock investing. Here's the first reason why I don't invest in stocks. These are my reasons. So I want you thinking about, what are your reasons? Okay. Like, you agree with what I'm saying, or do you have your own preferences? Because investing, you're the one that has to consume the end product. You're the one that has to live off it. Do you like it? So with stocks, I don't like them. Okay. The first reason that I don't like them is they're not tangible objects. Right. I was a retail financial advisor for the first part of my career, meaning I actually did stocks and bonds and mutual funds and all that stuff. And what I can tell you from being in that environment is there's a lot of manipulation that goes on. Okay. I don't like that. I don't like the idea that somebody else dictates how much money I make. Right. When I do a private loan, I'm in charge of that. I own the real estate, or I loan on the real estate. I choose my interest rate. I choose who's going to live there. I choose the payment terms. I choose everything. I'm not going to do something to myself that I don't like, right? That's not how it is with stocks. So when we look at stocks, there's two different things. There's price and value, right? So the price is what I pay for it, the value is what I get. Those two things are wildly disconnected, right? Like when you're buying a stock, let's look at this really quick. When you're buying a stock, what you're really buying is called discounted earnings. Discounted earnings, meaning this company earns X amount of dollars per year. So if I buy this stock, I buy this share of this company, I am literally paying them in advance for the future earnings that I'm going to get. Okay. What does that assume? That assumes that the company has to be profitable. I can show you a ton of stocks on the S&P 500 that are not profitable. Okay. Not only that, they don't even pay you a dividend, meaning if they are profitable, they don't share that profit with you. So if I'm buying future earnings and I'm not even getting earnings, what is it that I paid for? Like, what is it that I paid for? Is it speculation that it might do better in the future? Because that's not investing anymore. That's totally different. Is it the fact that they own underlying assets? Like they stocked up on a bunch of crypto. Why would I own the stock? Why wouldn't I just go buy the crypto then? You see what I mean? So I don't like the idea of buying an invisible thing because it really is invisible. It's a digit. You don't even get the stock certificate anymore. Okay, there's a corporation in New York. I think it's the DTCC, Depository Trust and Clearing Corporation, I believe is what that acronym stands for. Back, I think in the 90s or the 80s or 90s, they basically got their foot in the door where when someone buys stock, they're the ones that hold the certificates now. Okay, and I think in the 2000s, that went like across the board, no matter the company, like they are the ones that get your stock certificate. So if I bought a car, it wouldn't make sense for them to send it to some corporation in New York. If I bought real estate, it wouldn't make sense to me that they would send my real estate to some corporation in New York. If I bought a business, it wouldn't make sense to me that the business was owned or controlled by some corporation in New York. When I buy stock, why is that the case? If I don't even hold the stock certificate, what is it that I'm getting? Right? Let's think about this. When you buy stock, what are you getting? You're getting ownership, a share of ownership in the company. Well, what does that mean? When I own things, I get to do things with them, right? So what do I get to do? I can vote. Meaning I can go to a shareholder meeting and I can, write on the piece of paper what I think they should do. But the problem is, guys, the board of directors is not listening to me. They're not going to listen to me and you and what our opinions are, what they should do with the company. They have a CEO and a board of directors for a reason. They're not going to listen to the everyday investor. Okay? So voting is kind of more like a pacifier. It's like, cool, I got to express my opinion. They're still going to do whatever the hell they want to do, regardless of my opinion. Okay, so that's the first thing. The second thing is when a company goes insolvent, common stock shareholders are the very last people to get paid. Okay, first is you have taxes, then you have wages and contractors, then you've got preferred debt, you've got common debt, you've got preferred stock. All of these guys get paid first. If anything left, they pay the common stock shareholder. So I'm last in line to get paid. So why would I want that? I'm an owner. Shouldn't I be getting paid first? If I own the thing, wouldn't I be first in line? No, everyone else. The thing that's a kicker for me is wages. Okay. Wages get paid first. You're like, well, that makes sense. Wages should get paid first. Yeah, the executives' wages too. Meaning if the ship goes down, they can issue themselves a bonus. And they can still pay themselves instead of paying you because you get paid last, wages get paid first. See, I don't like that. I don't like that style of investing. I like tangible things. I like things that I can control, right? So when I look at that aspect of it, I don't like it. It's not something that I'm like, yeah, I have affinity for that. I'm attracted to that model. Okay. The second point is I only invest in things that I understand. Okay. So I probably knew stocks better than most. I was a financial advisor. I sold them for many, many years. And I can tell you all of the technical answers. I can tell you what all of the federal exams say and what the answers are and what the state exams say and what the answers are there as well. But I can't tell you that I actually understand stocks or mutual funds, like a fundamental, very basic level. I can't be like, oh yeah, I understand that. Right? It doesn't make sense to me when I look at the reality of what's going on there. And it's not like I'm illiterate on the subject. right? So here's something with investing, and this is not just investing, this is anything. When somebody understands something, it means they can explain it to you in a very simple way, right? So if you look at Wall Street, how much of that is simple? The language that they use, the terms that they use, right? They're not explaining it to you in a simple way, which means one of two things. What? Number one, they don't understand it, because if they did understand it, they wouldn't have to use big language. They could simplify it down, right? Who's ever had that conversation with somebody where they understood, whether it was cars, whether it was, physical health or nutrition, they understood it on such a deep level that they could explain it to you like a 5-year-old and it made sense. Okay. And you were like, okay, I get this now. I understand this now. Right. So that should be able to happen with stocks, but it doesn't. If you go on investopedia.com and you just type in stocks and you look at all the words and definitions and nomenclature and specialized language that comes up, none of it's simple. So they either don't understand it themselves, or they do, and they're complicating it on purpose because they don't want you to understand it. Okay. And here's the thing. It doesn't matter which of those it is. We can pick them as the bad and be like, oh, they're doing it all on purpose. They're making it more complicated than it is. Or we could be like, they don't understand it themselves. Neither of those are good. At the end of the day, the bottom line is it's complicated. It's not simple language. They're not explaining it to us like we're 5. And so either they don't understand it, or they do and they don't want us to. And I don't care which one it is. Neither of them are good. Right? Like the answer to that doesn't matter. So here's the thing is, when I look at stocks, like again, I'm buying future earnings. I've already gone over the price value thing. Just that I don't understand. Why is the price different than the value? And here's another aspect. Sure, there's supply and demand, but when you sell a stock, you're not selling it immediately to someone. You're selling it, and there's a third-party brokerage that holds it until a buyer shows up. If that buyer doesn't show up, they bid the price down until one does show up. Right? So it's not even about what's the stock worth. Then it becomes that broker doesn't want to hold that stock very long, and that's why the price went down. Regardless of the earnings, regardless of the value, regardless of what I'm getting. Right? So that was like, when I was a financial advisor, that was one thing I thought I understood. I was like, I know about diversification, and I know about all of these different ratios and measurement of returns and risk, and I know about stock being ownership in a company. But when I had someone ask me, Jerry, write this down, like explain it to me on the back of an app like I'm 5, and I couldn't do it. All I could do was repeat the complicated language that I was taught on my exams. I was literally asked, like, what am I getting? And I was like, well, you get ownership of the company. He's like, yeah, but what am I getting? Well, you can vote. Okay, well, are they going to listen? That's what was pitched to me. Like the board of directors, the CEO, they're going to listen to me. You're telling me they run a multi-$100 billion company. They're going to listen to me. I don't think so. I don't have a business degree. I've never run a publicly traded company. I have trouble managing my own finances, and they're going to listen to me. And I was like, okay, well, they're letting you. He's like, well, aside from voting, what do I get? He's like, if they go bankrupt, what happens? And then I went right back to what I told you guys. I was like, well, you get paid out in order. He's like, well, what's the order? And I went through the order, and I was like, last, right? You get paid out last. Okay. And I didn't understand that at the time when I was selling them, because you don't learn these things on the exam, explained again, in a very complicated way. So I don't invest in things that I don't understand. Okay, period. It doesn't matter if it makes me look dumb. It doesn't matter if it makes me look like unsophisticated. It doesn't matter if everyone else is doing it. It doesn't matter if I'm the odd man out. If I do not understand it, I'm not doing it. And if you learn nothing else in this course, take that home today. If I don't understand it financially, I'm not getting involved. Okay. And it doesn't mean that I drag my feet and I'm a mule every time and you've got to whip me into understanding. If I want to understand something, I'm going to. Right. But until that happens, I'm not investing. I'm not getting involved. It doesn't mean that I don't try to understand things. It just means until I reach that point, I'm not doing it. Okay. So the other aspect of this too is, not only liking and understanding, but we talked about the passive income thing, right? And this kind of fits into like, it's got to fit me as an investor. So I'm investing for passive income, right? I want passive income that exceeds my saved expenses and taxes. My private lending deals right now, on average, I make about 8 to 12%, usually closer to the 12% marker. Okay. I'm an accredited investor. I've been doing it a long time. I get good returns on my deals. So I'm making 12% in passive income. So if I invest, for example, $200,000, right, that's going to pay me 12%. Okay. So I'm going to be getting $2,000 a month in passive income. And I know that that's going to come in. So it's just a game of how many of those do I stack up that continue paying me every month until I hit PI greater than stat, passive income greater than savings, expenses, and taxes. Okay. So on a stock, I'm not going to get a 12% dividend. Now with stock, there's two different ways that you can earn profit. So let me sketch this out for you. The first one is called appreciation. Okay. The second one is income. Okay. Appreciation means that I bought it at this price here and it went up in price, and then I sell it to someone else for a higher price, and then I make profit. Okay, so that's appreciation. Income means it just pays me a dividend. The company is profitable. Because of that profit, they pay me some of it as a share every year in a dividend. And so I make my money that way. Okay, so here's the issue is with appreciation, I've got to sell the asset in order to get profit, right? So what am I selling the asset for? I'm selling it for currency. I'm trading a share of stock for US dollars. US dollars are going down in value every year. Why would I trade an asset for something that's going to go down in value? I'm trading something that could go up in value for something that definitely will go down in value. That's a bad trade, right? So that's the first problem with that. I would never trade an asset for currency. Never. That's a terrible idea. The second problem there is what about if Mark says you could rent it out? You can't rent stock out, right? You could do that with the asset if it's real estate. Stock, I don't think that that's a thing. You might be able to like lend it and like loan it to a hedge fund or something like that, but I don't think you can rent it out. But if it's real estate, you definitely could rent it out. The other thing is what happens when I sell all my stock? Okay, if I have to sell the stock to capitalize on the appreciation, the price going up to generate my profit so that I can live, what happens when I sell all of it? I'm no longer financially independent. My assets are gone. I'm back at ground zero, right? One of the basic philosophies is you never slay the golden goose. You never slay the golden goose. And so the thing that produces the income, the thing that produces the appreciation, that's the golden goose. Slaying it means I'm getting rid of it. I'm killing it so that I can eat. So I would never do that. And so that doesn't fit me as an investor. Now, the other problem is if I look at the income of it. So we're saying I don't want to have to sell it, which means depreciation almost means nothing. I'm not going to sell because I don't want to, because I don't want to get rid of an asset. And I don't want to put myself in a position where I run out of things to sell and then I end up destitute. So now I'm focusing just on income. Okay. On a good dividend paying stock, the dividend rate is about 4%. Maybe you can get 6. Okay. So I just told you I can get 8 to 12. Why would I settle for half? Right. I just did a quick search when I was putting together my material for this. And I was like, okay, let's find stocks that pay a higher dividend than 8%. The list is very short. Okay. The list is very, very short. And the problem there is I'm marrying myself to a percentage, regardless of if I like and understand the company. Okay. Because there's another aspect of liking and understand the company. The stock, I would never own pharmaceutical stock. Because I don't like pharmaceuticals. I don't like big pharma. I think that they're harming people. So I would never support them by giving my investment capital to them. I would not invest in something where the company and the mission, the thing that they're doing is something I don't like. So if I'm marrying myself to a return and just saying the dividend rate looks good, I'm going to pick that one. Okay. Well, what if that one is something that funds, war? And don't agree with bombing other countries just because they don't cooperate with us on the oil prices. I don't want to fund that, right? Or what if the CEO is a total asshole and he lays people off every year to make his numbers look good? I don't like that. I don't want to give that guy my money. He gets paid in stock options. Meaning if I buy more stock, his share prices go up. He makes money while he keeps firing people. I don't want that. Okay, so there's that aspect of liking. Then there's the aspect of understanding. Okay. Even if I like pharmaceutical company, I don't know the first thing about it. I'm not a pharmaceutical guy. I'm not a pharmaceutical expert or salesperson or business owner. I don't know that business. So I'm putting myself as a victim, hoping that they do a good job, hoping that that's a good business, hoping that that's a good industry when I really don't have any knowledge of the subject. It's no different than like, I would never go buy a restaurant right now. Could I? Probably. Financially, yeah, I could go buy a restaurant, but I don't know how to run one. I don't understand that business. If I got it, there's a good chance it might go out of business because I don't know how to manage and run a restaurant. So I would invest in a business that I don't understand. Okay. That's how you get stolen from. That's how you lose money. That's how you drive the business into the ground. So just because it's publicly traded doesn't mean that I don't have to think about what's the actual company, who works there, what do they do, what's their mission, what kind of people are they, what are they supporting, and do I like and understand those aspects? Okay. So on to the point of it fitting me as an investor. Okay. I personally, again, I like things that I can control. I like things that are tangible. Right. And you kind of have to think about this as an investor yourself. Like, what is it that you like? Okay. What is it that you dislike? And if you're a new investor, you might not know that yet. And you might not know that until you look at several deals and you research them and you start to list out, like, what are the things that I like? Okay. One thing that I don't like, I'll show you exactly what I don't like. I don't like this. I don't like graphs that look like this. Okay. In my business, if my graph looks like this, it's a problem. Okay. With my real estate deals, if my graph looks like this, that's a problem. Okay. In the stock market, if my graph looks like this, they say that's normal. That's okay. You just wait it out. Okay. So you see it kind of, the trend kind of goes up. It just keeps going up. Yeah. But what about this? Does this keep happening? Right. Nobody can tell you. Nobody can really pinpoint why a stock goes down and why it goes up and why a crash happens and why it doesn't. Okay. I don't like that. That's not something that I enjoy. I don't like looking at my portfolio from day to day and seeing these giant swings up and down. I like knowing my is going to come on this day, this month. Doesn't matter what the market does. Guys, I haven't personally looked at the stock market probably since, I don't know, 2017, 2018. Why? Because I have no investment there and I'm not going to. So I look at my bank statement. I look at my other assets. I look at deals, but I don't look at stocks. Okay. So that's a big aspect of it. Now, the other thing that I don't like spending a bunch of time on investments. If you're a client of mine, if you're a follower of mine, you know that I believe investing should be passive. It should be something that you buy your time back with, not sell your time for. Right. And so when I'm investing with stocks, I do have to research the company. I do have to look at their investor letters. I do have to look at their profit and losses. I do have to do research. Now, ironically, most people don't. They just go on their Robinhood app or their E-Trade account and they buy whatever is trending on Twitter or whatever their coworkers at work told them. That's not investing. That's speculating and gambling. But really investing, I'm talking about like what Warren Buffett does. Okay. The guy spends hours every day reading financial statements. That is his job. He trades time for that. Okay. I don't want to do that. Okay. My goal is to free my time up. Right. So that's not something I like an investor. And to really be a good stock investor, that is required. Doesn't matter what anyone tells you. If you're going to buy individual stocks, you will have to research the company and dive into their financial statements and understand their books and understand their executives and their business model and the economic forecast for their industry and all of these other things. Right. So that's something that I've got to look at. Now, if we move onto my next point of it's got to fit my goals. What am I going to use it for? Okay. We kind of hit this one already. I don't want to have to sell shares. Like when I do private lending deals, my intention is never to sell those. My intention is never to sell it. I put money in life insurance. My intention is never to get rid of it. So that's my utilization, the thing that I need it for, the thing I'm going to use it for. The goal is, again, passive income. And I can't get that with a stock. Okay, it does not fit my goals. Now, here's the problem is most people don't understand what their goals are. You've got to know what your goal is in the first place, right? We're just regurgitating what other people tell us. What is your goal? Oh, to retire and have a nest egg. What does it mean? You didn't come up with that. Who told you that? Right? And why did they say it? And usually it's like, oh, the financial advisor told you that. Oh, the guy who sells you the stock to make money told you that that's your goal. Makes sense. Okay, so this is like before I'm ever investing, just like I said at the beginning of this course. What is my purpose for being here? Same thing with investing. What is my purpose for investing? And if I can't answer that question, I shouldn't be investing yet. I definitely should be getting into something like the stock market. Okay. Now, the other aspect too of like, it's got to fit my goals. As an investor, it's all about profitability, right? I've got to make more than I spend. I've got to win more than I lose. And that's how I get to the point of being financially independent, is I keep repeating those habits and actions, right? So let me pitch this to you this way. When a company issues stock, they're selling something. Okay. Now, this is Wall Street that we're talking about. Do you really think that they're selling something for a discount? Just knowing Wall Street, like every movie that's ever come out about them, every news story you've ever read, do you really think that they're giving you a good deal? They're taking a loss so that you can financially benefit by buying their stock? No, they're making profit on it on the sale, meaning they're selling it for more than it's worth, meaning I'm already paying more than it costs them. I'm already paying more than the value is. See, on a good investment, I usually want to win on the front end. I want to buy a good deal at a good price. I already know that I've made my money based on how I bought it. That can't happen with a stock, because I'm always going to overpay, because the company issuing it is not going to issue it where they lose money and where they're not profitable. They will always come first. That's the first layer. The second layer is I can't buy it direct. There's always going to be a broker involved. They're always going to charge me a commission or a fee. Nothing wrong with that if they're adding value, but that's another layer of cost. I'm overpaying to the company that issues it. I'm overpaying when I buy it, and then I'm paying fees on top of that. And for what? There's no guarantee of anything other than those fees and the fact that I'm going to overpay. Right? That doesn't fit my goals. Like, I can't sustainably build financial independence on that model, overpaying for assets in markups and fees on something that can't guarantee me anything. Right? The other thing that doesn't fit my goals is I need to know for sure, like if I'm earning passive income off of my investments at a 12% yield, 12% of, let's say, $2 million, that's $20,000 a month. I know that that's there. But if all of a sudden my 2 million turns into half and it's only 1 million, okay, well, now I'm only earning 10,000 a month, right? The yield goes down, right? I'm losing value if I'm selling the value as well. Like I'm losing income when that happens. I'm losing net worth when that happens. That is a direct opposite correlation of what I need to become financially independent. So I don't want to get there the year, and this happened with pre-retirees. It happened in 08. It's going to happen from now until the stock market no longer exists as we know it. Okay. So if I'm at that point of, okay, I'm going to be financially independent next year, I'm going to retire next year, and all of a sudden the market crashes. Okay. And I lose half my portfolio. That's not something that fits my goals. That's the opposite. That's the antithesis of my goals. Right? Nano has a comment here. Let me actually answer a couple of questions. Let's go live for a minute, and I'll go over any questions we have. Let me bring Mark on. Mark had a question about renting it out, but he also had a question about selling puts. All right, let's see if we can mic with Mark here. All right, we're live with Mark. How are you tonight, Mark?
Hey, how's it going, Jerry? Nice to see you again.
Hey, it's good to see you too. You had kind of more of a comment about some other ways to generate income.
Yeah, I do. I'm in the stock market, but I'm very conservative, where I strictly I don't actively buy, but I've accumulated over the years dividend-paying stocks, which have reinvested over the years and built up a pretty nice portfolio of dividend kings and aristocrats that pay me passive income every month, and I go back and reinvest in those companies, and it seems to work out on me. And every once in a while, I do sell some puts on those stocks and create a small income stream with the strike price. And you know, I enjoy it. It's something that I understand and I'm comfortable with, and I enjoy watching the stock market. So I use it as a form of entertainment slash being involved, keeping the mind sharp and into the numbers. I like the numbers. I like the environment that I'm in. But I don't spend too much time on it. I'm very passive. I don't have the time.
Yeah, makes sense. Yeah, and I think that's a good point to bring up is the so with Mark saying is selling puts, and I don't think most people probably understand what that is. A put is a contract, and so you're basically selling a derivative contract. Put is the right to sell at a later price, I believe. So you're selling a contract to someone else that they can sell that stock in the future at a different price. Usually, I believe it would be set on a put contract. So that is a way you could generate income. I think for the average person, like there's definitely a learning curve there. I remember when I learned about calls and puts in my Series 6 and also my Series 65 exams, I spent a lot of time trying to figure out what those were. There's calls, there's puts, there's buying, there's selling. And so it's definitely, it's not the easiest barrier to entry to get into, but it definitely is something that can generate income on a stock. So good thoughts on that, Mark. Nano has a comment. Let me bring Nano on here. All right, Nano, do you want to go ahead and mic up?
Hey, Jerry, what's going on, man?
Hey, I'm good. How are you tonight?
Doing great, man. Yourself?
I'm good. You had more of a comment, it looks like, or maybe a question,
totally.
right?
Well, it's more kind of like of a comment that after investigation, and this is something that's in your book, after investigation, you was essentially decided that much of the stock market crash of 1929 had to do with Wall Street banks and firms manipulating the market to make the money at the expense of the American investor. So if that's a fact, it's proven, it has a record of it. It's like, to me, the way I look at it is like me sending my child, which I don't have one, like to a school that the teacher is a pedophile. Why would I do that? Like, you know that they're gonna try to rip you off. So that's more like, it has a proven record. And after that, what's put in place? SEC. And what else? Unregistered securities. And what else? Right, the correct investment, like all these barriers that come because of all of this individual that put this in place.
Yeah, and that's an excellent point. And that's in my book, Blueprint to Financial Freedom. And to add the cherry on top, the guy that they put in charge of the SEC was one of the people that he basically manipulated the market and ripped everyone off in the 1920s. So they're like, good on you, bud. Let's put you in charge of stopping this mess. Ironically, 2008, same thing. Okay. Who remembers 2008, where it basically was deemed it was an inside job? The banks caused that. Okay, they did it on purpose. They were selling, crappy mortgage portfolios to the American consumer with investments. And at the end of the day, like the taxpayer bailed them out. None of them went to prison. I think one guy did. He wasn't even involved in it. He was like a peon, basically. And Hank, what is his last name? Hank something. He was either chairman of Lehman or chairman of Goldman. I think he was chairman of Lehman. He became the U.S. Treasurer after that. Like Secretary of U.S. Treasury, he was leading the charge to rip off American consumers. Okay, think about that. Like they're not only, like Nano said, they're not only ripping you off, also then awarding these people and putting them in positions of power. Okay, I don't want that. Like, and the beauty of when I do real estate, when I do private lending, none of that happens. There is no market. There's none of it. It's just that guy lives in that house and pays me. And that's the extent of it, right? If he manipulates me, I can kick him out, take the house back, and find someone better. Okay. Henry Paulson is the politician. He was CEO of, I believe it was Lehman when the crash happened. He was either Lehman or Goldman. Crash happens, 08, and then he becomes the Secretary of Treasury. Okay. Like that shouldn't be a thing where they're like, oh yeah, we're going to put this guy in charge of the finances of the United States government now after he ripped all of these people off. Right. So, Marx, all you have to do is look at who is in charge of our monetary system. They're not any better. That's true. And a lot of this is interconnected. Okay. Wall Street, banks, the IRS, they're all in bed together. Right. And so like Nano's saying, like, if you know that there's muggers in the alley, why even go in the alley? There are so many other ways to make money. You don't have to do that. You don't have to put yourself at that risk. So when I look at, again, what fits my goals, getting financially mugged isn't a goal of mine, right? And like being defrauded by politicians and giant Wall Street firms and bank isn't the goal of mine. Okay. And Nano adds, after the instance that they have a known record of being people off, people still overlook that. And that's the power of marketing. I mean, when you look at how much of the US economy these Wall Street firms and banks are involved in, we're talking like retirement plans for giant companies. We're talking about government retirement plans. We're talking about union retirement plans. Like they have their hands in everything. right? In '08, the US government got bailout help from BlackRock. BlackRock is a Wall Street firm, right? So when you look at just the level of like penetration they have with every aspect of the financial system, the best bet is to remove yourself from the system. If there's poop in the water, why even get in the pool? Right? Like it's not, there's no point in justifying like, oh, well, it's only in that corner. Like I watched the movie Caddyshack with Lexi a couple weeks ago. There's that scene where there's the turd in the pool. If you guys have seen Caddyshack, like everyone gets out of the pool. Right? But with this Wall Street thing, we're saying not only is there poop in the water is poop. There's water in the poop. That's how much poop there is. There's a little bit of water in the poop, and people still get in and swim. And they're like, oh, well, you might find a peanut, right? Like you don't want that peanut. That's not a good peanut. Okay. So these are all aspects you've got to look at. Now, the other thing too is I've got to look at what's vital. Okay. So what do I like? What do I understand? What fits me? What fits my goals? What's vital? Vital means that it's something that is like, it's dependent. Like people are they have to have it. You're dependent on their survival depends on it. Right. So when I think of vital, I think about what do we need? We need oxygen. We need water. We need food. We need shelter. We need clothing, right? We need transportation. We need healthcare. Like these are all things that the average human being relies upon. Okay. So when I'm investing, I want to invest mostly in those areas, right? That's why you see me invest in private lending. People need places to live, right? And that's something that I can depend upon. Like my big philosophy is if I stick in those areas, even in the economic downturn, those items are still wanted and needed, right? So look at stocks, look at the S&P 500, look at the Dow. How many of those companies are vital, right? How many of those companies are vital where you're like, okay, if a crash happens, they still need that. And the answer to that question is which ones lose money in a crash? If they lost money in a crash, they're not vital, proved by their own statistics. Right. So I'm looking at this and I'm saying, okay, well, when I look at, oh, wait, who lost money? All those guys aren't vital. Right. Like, and you can look at like in 2020, who made money, right? Zoom did really well. Amazon did really well. Those were vital during that period of time. One of my mentors early on, when I asked him what he invests in, his answer was water. I had no idea what he meant. And later on, when I started learning investing with him, he was buying up the water rights to subdivisions. And he's like, yeah, they got their mortgage and their rent and everything, but all those things, like they need water. If they're going to live in that house, they need to be able to take a shower and flush the toilet and turn on a sink. So before any of that, they're going to pay their water bill, right? And if they don't, like I can shut the water off, right? But people don't live without water. So you're going to always have that need. That's always going to be a demand that's applied. So that was something I took to heart is it vital? Okay. And a lot of the stock market's not. A lot of it is hype. A lot of it is speculation. A lot of it is innovation. And there's nothing wrong with innovation. But sometimes the wheel is just round, guys. There are certain things that are never going to go away. The need to eat will never go away. You can't innovate around that. Okay. Having to have a roof over my head will never go away. You can't innovate around that. Needing oxygen to breathe, you can't innovate around that. Having to wear clothing, you can't innovate around that. You might improve upon the clothing that exists, but it will still always be there. Okay. So those are all things that like, okay, if I stick in that zone, okay, electric vehicles, not vital, right? Internet technologies, not vital. Digital coins, not vital. So those are the things I look at. Now, the other thing then that I'm going to wrap up on this point is overpaying. Okay. We've already gone over the price value thing. Unless you're like Mark, where you're spending time looking at financial statements and you like the numbers and you like the spreadsheets and looking at this, you're not going to know the value of a company. You're going to look at the price. You're going to look at some chart and you're going to say, oh, it's going up, I should buy it. Or you're going to be the devil's advocate saying, oh, it's going low, it's on sale, I should buy it now. That's not value. Value means there's an actual mathematical formula that I take the company's earnings and their assets and their numbers and everything, and I plug this into that mathematical formula, and it gives me an actual finite value. And that's the thing I should be looking at. If I buy the stock, this is what I'm getting. I'm getting a share of this actual number, regardless of the price. Okay, so most don't do that. And so I would venture to bet most people overpay. Right. And like I said, when a company issues stock, if I'm going through an initial public offering on a stock, the first thing that we've got to realize is that that company is not issuing stock at a loss. Okay, they're not going to sell themselves for less than they're worth. right? They're going to sell themselves a profit. They're literally selling themselves to a public investor. They're not doing it at a discount. Okay. Not only that, there's a pre-IPO funding round. This is where the big banks get involved, Barron's and JP Morgan and all these guys, right? So they're getting in before the public get in on the initial pre-IPO. They're buying at kind of a wholesale price, then the public gets it. So you're getting the leftovers. Okay. Now, if you buy it individually at that time, like you're getting better leftovers than everyone else. But if you're buying it in a mutual fund, if you're buying it in an annuity plan, if you're buying it in a retirement plan, that literally is the soup of the day. Okay. And what I mean by that is when you go to a restaurant and they have the soup of the day, that's the stuff they couldn't sell all week. So they throw it up in a soup and then they make sure that the waiter talks to you about it, or the cash roll, or the special of the day. That's the food that's about to expire. And if they don't get you to buy it, it's going to go in the trash. They're going to lose money. When you're buying that stuff in your mutual fund and in your retirement account, that's what you're buying. Okay. The pre-IPO people, they didn't want it anymore. The individual investor didn't want it anymore. The institution didn't want it anymore. The market maker didn't want it anymore. The trader didn't want it anymore. Now you're the retail guy and they're like, here, have this peanut we found in the pool. If you catch my analogy there. Okay. So again, I don't want to overpay. And if I can't even mathematically calculate what does overpaying mean, I don't want to be involved in it. Right? I can look at real estate and figure out, okay, what's the intrinsic value of it? Right? And I can make sure that when I do an owner finance deal, I'm making money on the front end. Right? So these are all things that I can ensure of. On the stock, I don't know if I'm overpaying or not on the entrance, and I don't know what it's going to do in the future, so I can't even guarantee that I'm going to sell it at a profit. Okay, so these are all things to consider. Now, again, I didn't jump into a bunch of technical, rate of returns and Sharpe ratios and all these different things and again, nomenclature of the stock market. I don't think any of that matters. If you can't answer yes to all 6 of these questions that I went through, do I like it? Do I understand it? Does it fit me? Does it fit my goals? Is it something that I believe is vital? And am I not overpaying? If I can't answer that, then, okay, well, what am I really buying? Right? And why am I investing in something and trying to get into the numbers and the charts if I can't answer those questions? Okay. So guys, what I'm going to do is I'm going to open this up for questions here. Let me see if you have questions, if you're on Zoom, drop them in the chat. If you're on Facebook, drop them in the comments. I'll go through Facebook first and then we'll jump into Zoom next. All right, so let's see if we have any questions here on Facebook. It's good to see everyone, by the way. Okay, Facebook. Let's see if we have questions. Justin, it's good to see you. Hannah, good to see you. Andrew, good to see you. Brian, good to see you. Jessica, good to see you. Good. I don't see any questions on Facebook. Let's jump into our Zoom questions next. I hope that the audio straightened itself out. All right. All right, we have another question from Mark. Mark has a question about precious metals. Let me bring Mark back on here. All right, we're live again with Mark. Mark, you have a question on gold and silver?
Yeah, Jerry, thanks. I hate to manipulate all the time out here, but I always have, especially in this economic environment that we're in now. I have been actively buying precious metals more than normal, but I always have that FOMO of am I getting the best price for what I'm buying? And I search all my resources, and still every time I pull the trigger, it's like I have that fear that, okay, did I pay the correct price or the best price? But I struggle with that every time I make a purchase. How do I get over it?
Yeah, that's a good point. So Mark is saying basically when you buy physical gold and silver, and I'll kind of walk you through how this works. So you have people that mine gold and silver. So they actually pull it out of the ground, and these miners, they sell it typically to a refiner. To the refiner, they put it through the refining process, they purify it, they get all of the impurities and other elements out. So it is just like pure gold. And the refiner, they're typically going to sell it to an assay, which might, shape it, they'll mint it, that type of thing. And then the minter, the assay, they'll sell it to a wholesaler. The wholesaler will then sell it to a dealer or a distributor. And then the dealer or distributor will sell it to an end buyer or investor. So each one of those people charges more money each time. So there's a little markup every time. The miner, he marks it up when he sells it to the refiner. The refiner, he marks it up when he sells it to the assay. The asset, he marks up when he sells it to the mint, to the wholesaler. They mark it up when they sell it to the dealer, who then marks it up when they sell it to the client. So with the mint, like when you're at that assay mint stage, there's something called spot price. Okay. And so this is basically like on the bullion contract market. If you're buying, at a mint level, like you're paying spot, you're paying the market rate price for bullion. Okay. Everyone else beyond that point is never going to pay spot. They're always going to pay spot premium. Right. So what the market is saying is you're buying the bullion, you're looking at, okay, well, what am I paying above spot? What's my premium? Right. Now, when I buy, that was a concern of mine at first too, was like, okay, well, I want to get the cheapest price, I want to lower the lowest premium possible. The first thing that I had to look at was I was spending a lot of time on that. I was going to all different websites. I was looking for the lowest price. And what it came down to is unless I was placing a really, really big order, I was saving like $20 on an ounce of gold. And I decided to look at my time and I was like, I just spent an hour of time doing that. Okay. What if I'd spent that hour selling or marketing or doing something actually productive? Because my time is worth a lot more than $20 an hour. So that was something that I had to break. It was almost the poverty mindset of like coupon shopping. I grew up with that when I was little. So I had to look at, okay, well, what's time worth? A couple $100 an hour, a couple $1,000 an hour, doesn't matter. It's more than $20. And if it's more than $20, then I'm not going to waste $20 an hour time on trying to lower my bullion costs. So then I became more focused on, am I buying, obviously good products at a fair price. But the big one for me is, what am I paying when I sell? Okay. Because a lot of these places, they will charge you a fee when you sell. They don't buy it from you at spot. They buy it from you at spot, and they're going to charge you 1 or 2, 3% when you sell. Okay. So it's kind of the idea of, do I want to tax the seed or do I want to tax the harvest? I'm okay paying an extra 1% or whatever on the buy if I'm not going to pay anything on the sell. I would rather pay 1% of $2,000 on an ounce of gold, $20 today, than paying 2% on 1 ounce of gold when it's $4,000 and I'm selling it. Okay. Now I'm actually paying higher fees on the back end. So that's the big thing I looked at there. The other aspect of it as well, there are membership sites where you can buy wholesale. We're one of them. So we have several ways where you can get wholesale pricing through us, and you can get your spot prices down lower. But I shouldn't say spot prices, your lock-in prices down lower. But the thing that I realized, Mark, in 2020, especially when the silver market went for that run, spot and retail are no longer connected, right? Like I used to be able to buy wholesale. I used to be able to buy silver for 45 cents per ounce over spot. Today, I'm going to wholesale. I'm going to pay $2 to $3 an ounce over spot. And that's before I sell it to my client. Right. And so even though the spot price on the market where they trade contracts may not have increased that much, the physical price did, because the supply is so low. So I started actually ignoring spot and looking at, okay, what is the actual physical and what's the demand like? And I have a little more insight to that because I am a wholesaler and a dealer. So I can actually look at what do my people I buy from, what are they selling at? Because they're on very slim margins as well. And I can kind of get a feel for, okay, there's not a whole lot of supply in the market, right? The other thing I look at is shipping times. If it used to take, a week to get bullion and now all of a sudden, it's 2 months, which happened in 2020, I can also see that there's a supply issue there. So that's where that spot price and the retail price completely come unhooked. And then I'm looking at, okay, well, more so what's the market condition? So those are a couple things to look at. But again, big thing is I don't waste a bunch of time up front trying to save the money if I'm going to overpay on the back end when I sell. And then again, membership sites, you can get wholesale pricing. And then obviously, looking at what's your ROI as well. And I would say that's the final point. If I'm just buying it and holding it, and yeah, it really, really matters what I buy and sell for. But if I'm borrowing against it, if I'm leasing it out, if I'm earning income from it while I hold it, it doesn't matter as much, right? Because that fee that I pay, that gets overtaken by the income that I'm getting from borrowing against it, investing it, or leasing it out and getting a yield on top of it from there. So I hope that answers that? That's a really good question. And I think that that's something a lot of us, especially when we start getting into bullion, a lot of us run into that. Good. I think we might have a couple more questions on Facebook. So Hannah asks a really, really good question. Hannah is on Facebook. Hannah says, how do I start? As a small income family, I want to know, where can I start investing? It needs to be manageable for my current situation. That's a great question. So Hannah, the first thing I would say is grab a copy of my book, Blueprint to Financial Freedom. Okay. This literally answers the question of where do I start? It goes from, phase 0, just starting out, all the way through achieving financial independence, and it goes step by step. If you go to jerryfetta.com/B2F, you can grab a copy of that. You can also connect with Nano on my team. He'll do a free call with you and answer your questions. As far as where do I invest, what do I do with money that I have? The first place that I would start is your knowledge and financial literacy level. Okay. And that's going to be like for probably a period of time before I put money into gold or silver or real estate or anything else, it's going to go into my financial literacy level until I feel like I'm at a point where I'm like, okay, I can keep my head above water when I talk about this stuff. I can hold a conversation. When I watch these webinars, it makes sense, right? I can go to investor meetings and talk to sophisticated people and know what they're talking about, right? It took me a while to do that, to answer Hannah's question on where do I start. I remember, so there's a guy in my life that did a lot of mentoring with me. I remember when he used to speak, for me, it was gibberish. And I loved being there and I loved listening because I was like, man, I can tell this stuff is important and I want to know this stuff and I have so much interest. But he'd start talking. I was like, I don't know what the hell this guy's saying. So I would go back and I would read and I would learn and I would watch videos and I would increase my knowledge. Each time I'd sit down and hear him talk, I understood a little bit more and a little bit more and a little bit more. And it finally got to a point where I was actually able to carry on a conversation with him myself. And that's the point where I was like, wow, I have the hang of this, right? Just like with anything, like I have the hang of this. I understand it now. I can actually like shoot the shit with someone and know what they're saying. So that would be my answer to that. And that's an excellent question. Mark says, great points on the bullion. Yeah, Mark, reach out to us. I don't know what you're paying for pricing. Reach out to Nano if it's something that we can help out with. Like I said, we have a membership where you can get wholesale pricing and a couple of different things there as well. So that might be an area that we can help out with as well. Guys, I think that's all I see for questions. Thank you guys all for tuning in. Hope you have a fantastic weekend. And if you're watching this and you don't yet have a copy of my book, Blueprint Financial Freedom, jerryfetta.com/B2F. Other than that, we will be back again next Friday. And if you're a client, our first Tuesday talk is this Tuesday, 7 p.m. live client Q&A. We'll send out the link for that. Other than that, have a great weekend. I'll talk to you guys next time.